Hi everybody, welcoming you all again to another episode of RefreshColombo. We have three talks lined up for you today. First off is Mafaz. He's been around, I'm sure you guys have seen him, maybe chatted to him on the off occasion, but now we get to, learn or at least hear from him what he actually does. So Mafaz, before I kind of steal your thunder, I'll let you take it over.
Okay. Good evening. Can you hear me? Is it working? Okay. Great. Hi. This is probably the first time I'm coming to Refresh and not hearing a technical talk. I wanted to give you some background on what the nature of venture capital was and how VCs look at investing into companies, what we're about, that we're not there to steal ideas, that we are there to try and help you along, but there's a cost for that, and that's usually a share of the business. And I'll try to address all of this in the 20 minutes that I'm given. I'll probably overrun, but if you have any questions, please feel free to ask at any time. So this is the basic outline of my presentation. I probably won't cover the areas I'm interested in because it spans a huge horizon. But we can discuss that at length later. So what do VCs actually do? Right? I thought the best way to give this to you was through an analogy. Meet Sri Lal. Sri Lal has invented an ice cream that never melts, right? He's the entrepreneur. I'm sitting there with a bunch of money, right? I've got to find investments for this. Sri Lal approaches me and says, hey, my ice cream is better than everybody else's because it never melts. I'm thinking, I love ice cream. This could be big. And he says, I need money to build an ice cream plant. So I make him a deal. I said, I'll give you 5 million rupees for 50% of your business. He's making tons and tons of ice cream, right? It's going out the door like he could never believe. 1 year later, he comes back to me and says, hey, we're selling 1 million ice cream cones a day. We need more money to keep growing. I'm thinking, this looks like a time that I call up others, get involved. People who have a link to the ice cream industry. I only know ice cream as a consumer. So I speak to my two friends, Jit Gunaratna at Elephant House and Ranjit Page at Cargill's and say, guys, there's this really cool ice cream. Yes, we've heard about it. This guy Sri Lal, no? Yeah, I've invested 50% in that company and he's looking for expansion. And both of these guys get, oh my goodness, well, maybe we should just buy him out, right? And so Sri Lal gets into a bidding war, which is perfect. I'm happy, he's happy. These two guys are going, okay, I want to control this business, so they're also happy. And he sells out for 20 times his original money. In our language, we say that's 20x, a 20x return, right? And he's going to buy a new house, and he's going to donate millions to Sri Lal ice cream. So in the end, we sell the business for 200 million rupees. 100 million goes to the entrepreneur. 100 million comes to the venture capitalist. And I'm thinking, where should I invest next? Right? Is that, in a sense, is what a VC does. Oops. venture capital is a term used to broadly define investment in early stage companies. It can start with you setting up a business on the back of a napkin, right? I've seen this happen. My first venture, which I set up, was when I was in school, when I was in university. It was a friend of mine who came to me with a problem and said, you know, in the US, you have this, every single election has to, anybody contesting. Now, you have elections for everything, from your district court judge, through to the state's attorney, through to the Senate, the president, but they all have to set up an office. And he basically said, now in Texas, where I was, we've got to run these offices. And he worked for the Texas Democratic Party. He says, I've got this list of people who are going to be contesting in the next year. They all have to set up offices. He says, I don't have anybody technically that can do this. Why don't you come along? I was working on a PhD, which was going nowhere at the time. And it looked like an interesting offer. So we actually sat down and drew out a little plan, said, okay, how would this work? What kind of money can we make? And we put it together. We actually ended up exiting after 14 months to a larger player. Now, you get many types of venture capital, right? You get angels, you get VCs that support early ideas with little market traction. You get private equity. The hat that I wear normally is that of a private equity. We invest into existing businesses, those with a fairly long track record that need extra money to get going and revive up. And then you also get mezzanine finance, which is investors providing funding just before an initial public offering. IPO stands, this is when you go to the Colombo Stock Exchange or you go to the NASDAQ like Facebook did last week, right? And then you get others that are, you know, specialized, what are called buyouts and leverage buyouts and distressed. But these are just niches of that. And what we're discussing is venture capital. What are angels? These are so-called people with wings on their back and who come in and save you and give you lots and lots of money for a small portion of your business. They tend to be people who have made made money themselves as entrepreneurs. They are looking to do very early stage seed investment. There was a Sri Lankan who was in Facebook. I forgot his name now. He was the marketing manager very early on. He's now doing a lot of angel investing in California. And occasionally you'll get angel funds, right? This is where people pull together and say, we're going to pull together and invest. And this is what is happening with the Indian Angel Network and what they're doing with the Venture Engine, for example. We're looking for seed companies that are just starting out. But know this, right? The typical expectation of an angel investment is 10x. If you give them $1, you're expecting 10 back. If you give them ₹1,000,000, you're expecting 10 million back, right? Then you get the VCs. Right? The history started around MIT and Stanford in the early 50s. And you get the big ones, Kleiner Perkins, 7 Rose, 3i is very big in Europe, for example. You get here locally some Lanka Ventures, Blue Ocean Ventures. We tend to look for proven management teams, right? Or IP, intellectual property, that basically creates a barrier to someone coming into that market. Again, looking for large addressable markets. What does this mean? Is Sri Lanka a large addressable market? Yes, it's growing. You now have 2 million online users, right? The proliferation of internet is growing. The mobile telephony is growing. It's at 17 million. So it is, and it's growing. And what's great about Sri Lanka is it's a great prototyping for things like India, Bangladesh, Pakistan, Laos, Cambodia, Vietnam, right? If you can make it here, you can make it anywhere, to quote the old song. So what is our business model, right? Typically, you'll make an investment, and 1 out of 10, you expect to sell that business, that investment off in 3 to 5 years, right? You will get one big home run, one 10x, right? Every one you expect to be a 10x, a 10 times return, but it doesn't usually happen. This is over the last 50 years. You get 4 marginal survivors, those that you probably sold on for what you put your money in. You get 3 on life support, probably need another round of funding, maybe you may get your money, and you'll probably expect 2 total failures, right? Typically, everyone aspires to give you a return in excess of 30+%, right? It actually translates to very few achieve this, and what happens is its returns are in the teens. This is what I call the financing life cycle. I usually try to show this, but this is what we call the J curve. It's based on your internal accruals, right? When you start out, your costs are higher than your revenues. And as you go in your first year, you've lost more money. You're losing even more money in the second year. And in about year 3, you're breaking even, right? This area here is called the Valley of Death. It's where you run out of cash, and it's very difficult to survive. Think of cash or cash flow as the blood of your business, right? Without blood, your body can't survive. It's the same here. You need to have that cash flow to survive that. And then it starts getting better, right? Your revenues are more than your costs, and your internal accruals start to look positive. So how does this translate into Series A, Series B, Series C? And you may have heard these terms, thrown around, right? We look at Facebook. Their first series was when Peter Thiel came forward with $500,000. But this area here, you survive with angels and FFF. What does FFF stand for? Sorry? Friends, family, and other fools. Right? Whoever else you can convince to invest. Right? Actually, going back to the story I told you about that first company that I set up, we ended up selling it because of the other fool. The other fool was my partner's girlfriend's father, right? And being uneducated in the space, it's like, oh, okay, I'm getting, I think I had 10% of the company. And he says, I'm coming forward with all the money, so I want 80%, they took 50%, and David took 40%, right? And I was like, okay, that's fine. I thought I'm happy with 10. I didn't put any money in. I was going to do the work, and I was drawing a salary from it. It was him who sold out because he had the majority of the share. He had 51%, sorry, right? And there's certain things that you learn very quickly is to learn to read your contracts. And in the articles was something called a dragon tag. Basically, if he sold out, the minority had to sell out as well, right? Now, I caution you on this, but learn. You got to learn to read everything that you sign. So you get your first round, your Series A, and your second round, and your third round. And if you look at the history of Facebook, for example, right? The first, second, and third valuations just went up by multiples, right? The first round was done, they were trying to sell out to Yahoo in 2004, when they still didn't have a revenue model, right? And then the second round is when SkyTeam, Digital SkyTeam, Mail.ru, all those guys started rushing in. And the third round was done at a valuation of $50 billion. And their IPO was done at a valuation of 102. And it subsequently crashed. But what this allows you by going public is the ability to further raise capital by being a publicly listed entity. And you can appeal to the larger mass of people. Right? So, what are we looking for as VCs? And I put this as first, right? Is the team. Are these people you can back, right? Am I going to give my money to guys who are going to go out and go buy a new car? No. Are they going to buy new servers and, are they going to do what they say in their business plan? Yes. Do they have domain experience in this area that they want money for? I hope so, right? Do they have an ability to collaborate with each other, right? Do you have, are you a lone wolf sitting there just doing stuff and say, oh my God, I'm going to have to do this all by myself? No, you want people who can build a team around them and inspire them and get stuff out there and get it going. And this is also really critical, a willingness to allow VCs to help build a team, right? If you want to get into the Thai market here, with a new product that you have. How many of you know people in Thailand? How many of you know people that you could expand into the US or the UK or Africa or Singapore or Southeast Asia? VCs tend to have a larger network, and you need to be able to sometimes get that help. Sometimes you shouldn't be the CEO of the company, right? You're the techie. Maybe hiring, firing people isn't your strength. Maybe, you've got a vision for the company, but you're not able to translate it. And this is what VCs also bring, is that help and helping you realize what your potential is. We're also looking for emerging and fast-growing markets. Generally, bad markets make for bad companies, right? Anyone here work for Sri Lankan Airlines? Okay, I do not invest into airlines. I studied aerospace engineering and aeronautical engineering, but I never have invested into an airline in the history of my almost 30 years of investing, right? Why? It makes for bad companies. It's basically an industry that's regulated. You're subject to government. You're subject to much worse than the government, the price of oil, right? You can't predict these things. How will you make money, right? This is absolutely critical. I know everyone's these days, you know, I've got, what is it, secondhandtoiletpaper.com or whatever it is, right? And they're trying to come and raise VC capital, but I'm a bit old-fashioned. I want to know how you're going to make money with it, right? And most people that I speak to around who are also investing want to know how you're going to make money with it. Defensible technology, intellectual property, these are really key. Are you inventing something? There's someone in here, in this room, you've actually seen, did some really cool stuff that could have been very, very defensible, you know, had IP. Now, if you look at what's happening in the Groupon space, for example, right, there are a lot of Me Too's, you know, people swarming into something that they see an opportunity on. You generally want to get something where you say, right, okay, I see what the technology is. I see what the intellectual property is, sorry. What's FP&A? Financial planning and analysis, right? You know, you need to expect that these guys who come in and give you money will want something back in return. Set of monthly accounts, for example. You know, that you're meeting certain KPIs, key performance indicators. That, you know, even sometimes provision of back office and infrastructure, right? You know, you may not have an accountant. I can lend you an accountant for the next 6 months, or he'll come and do your accounts for you, right? You should expect acceleration from a VC, right? Someone who gives you money should be able to help you say, right, what I wanted to achieve in 2 years, we should be able to do now in 1 year, right? And this is also really critical, objectivity and insight. Providing you some kind of balance, saying, you know, if we do this, say, no. You sometimes need someone to just hold the reins back, right? So just going back to the Facebook story, right? The whole problem with Eduardo Saverin was he was controlling, every single decision had to go through him because he was controlling the reins. And when these two moved, when Moskowitz and Zuckerberg moved out to Silicon Valley, Saverin was at an internship on Wall Street and couldn't be bothered anymore with these guys and wasn't making any decisions. And it was, what's his name? Sean Parker, who came forward and said, look, you got to reduce this guy's control. Right? And if you've seen The Social Network, you remember that classic scene. Right? But that was, you know, him giving insight and a sanity check on how to go forward. All right, I've gone way over time. The second thing you know, just a suggested playbook for you when you're discussing. I have a format, it's gone out to those if anyone's interested. Hire a great lawyer. Okay, as I told you, reading every single document is absolutely critical. Okay. Figure out what stage and sector you're in. Identify 4 to 5 firms that focus on this stage. There aren't that many around here, right? It's growing. We're trying to build up this ecosystem, you know, of investors who are interested in new technologies and new ideas in entrepreneurship, through to incubating companies and really getting it going and really firing it up and hopefully keeping the government out of it, right? But we're you know, all very, very committed to it, but it's difficult. Get an introduction to someone. Okay, I come here nearly every week, every month. There's another angel investor here, right? But, you know, also prepare a deck. And, you know, expect to speak for 30 to 45 minutes. Very important is the goal of the first meeting is to get a second meeting, right? You want to keep the conversation going. You want to keep those guys with you in mind. That's my, I wanted to do, this is one more thing, a la Steve Jobs, but I'm not that creative. That's my email address and my Twitter handle. If you have any questions, I know I'm running very late.
Just one thing.
Sure.
You mentioned IP and copycats.
Yeah.
This market in particular is quite interesting for trying to protect IP. You know, I come from the UK where it's hard enough anyway.
Yeah.
And very expensive, actually. You can spend all of your money getting patents.
Yeah.
I'm a designer, so like it's a similar kind of world, but
Right.
spend all your money protecting patents and never actually get a product to market. And then someone can make the smallest of change and essentially say, well, it's not copying.
Yeah.
So what's your advice for like where to draw the line between just getting your thing out there and being the best at it and spending all your time protecting IP and worrying about whether people are copying?
Get it, go to market, get it out there, and then start protecting. You're absolutely right. Protecting, even here in Sri Lanka, you know, to protect a single design or a single logo, it's relatively inexpensive, but then you have 25 different classes that you need to look at, right? But get your stuff to market, right? And then worry about protecting it. Go ahead.
Any examples of success stories in this market for, you know, successful stories, you know, companies are coming and exiting in the recent past?
Sorry? The one that's talked about most is Millennium IT. The returns to the investors, though, was not that great. Right? It was in the teens, high teens. There are a few, Virtusa, you know, but it was always dealt as a US-based entity. But what we're seeing now is a lot more entrepreneurship in that space. Sorry, just on that same note, the VC industry in this country sort of started around 20 years back, in about 92, 93. And it never really took off, right? The worst thing that they did was put a bunch of bankers to become venture capitalists. And, you know, they're very risk averse. And instead of looking for opportunities, they were looking at, will we get our money back? That's the $1 million question.
Yeah.
Right? Yeah, I mean, we're looking at this right now. You know, how much do you give up? Right? What is it worth? How do you do a valuation on a business that has nothing but an idea? Right? And the guy committed to delivering that. You know, it's how long is a piece of string? It's really very, very subjective, right? For companies that are never going IPO for a VC, you look at either a secondary sale. Can you sell this on? Can you sell it back to the founder? Do they want it back? Do you look at a trade sale, right? Can you sell this company off to somebody who's looking to come into into that particular space.
Just make one thing there. The VCs never look at controlling shares.
Sorry?
VCs never look at controlling shares.
Not always. Not, there are some that take larger shares. Not you wouldn't take 50%, but you may take a very large minority. Yeah. It's the risk-averse nature of the banks here, right? Are you talking about the like Lanka Ventures and these kinds of companies? Yeah, they're no longer VCs by any measure. They are a collection of institutions that are owned by a particular company. There is a growing, like Blue Ocean Ventures, ourselves, Kalamanda Capital. I don't think you have an entity, but there are others coming forward now to come into that space and really looking at seed funding, looking at companies, and saying, okay, we'll take a bet on this entrepreneur. Yeah.
Okay. Basically, they have a few students sign up. I think Eddie knows about this. An entrepreneurship hub, and basically they get a few groups of students, and they come up with a business idea, and then the World Bank basically funds it.
Okay.
So that basically what they did was they gave the students, the mentor of the students to come up with a really good business plan.
Right.
For about 3 years forward.
Okay.
And then they would figure out who would actually have a good idea or a good plan, see whether that will go forward. Is that right, Eddie? Yes, that's it.
After this, we'll go for the break.
So, considering that a lot of the, unless I'm wrong, the companies you mentioned seem to, the sort of success stories, do a lot of work outsourcing. Would you say that people are more likely to invest if you've got some amazing idea that's going to do that kind of work? Or with the sort of growing market here now, post-war and everything, would you say that there's more opportunity actually looking inside the country? Or is there nothing, it does not matter, it's just the idea? And
It's the idea, and the ability to execute, I think is just as important. Actually more important is probably the ability to execute. We're looking at more at, okay, are we looking at companies that are doing outsourcing work, or, or companies that are, we're looking for ideas right now, is where, yeah, that products and services that can be scaled, that's also very, very critical to emphasize. Sorry, go ahead.
What's the ideal exit period what a VC looks into?
3 to 5 years.
3 to 5. It's a size of the organization depend on it, or?
The organizational side, the idea is to exit within 3 to 5 years. The organizational size should be to a certain magnitude that you would want to exit at that stage. We're very happy to look at them. Very, very happy. Again, it's about, can you credibly tell me what it is that, or can these companies tell me what they want to do? And do I see a market for that? And it's like, okay, yes, I can see this. Brilliant idea, Yeah, it's very, very different. It's very hard to put a valuation on them.
Unfortunately, guys, unlike VC, we have to make a quick exit. Yeah. We've got refreshments outside. So before we run off, big thank you to Mafaz. Can we get a round of applause? So.